A new AM Best report explores long-standing troubles at the federal flood insurance backstop, which have been exacerbated by Hurricane Ian, along with how market shifts are impacting private flood insurers. David Blades is an associate director, and he's here with Christopher Graham, a senior industry analyst, both in AM Best industry research and analytics department. And Chris, flood insurance premiums increased by 40% last year. What's driving that?
Hi, John. Thank you for having me today. Really, there's two factors behind it. One, the private insurers can offer limits beyond what NFIP offers. So those who are required to have it, would be getting it from the private insurers because home values have increased. What might have been adequate from NFIP no longer is to the insured. The other part behind it is the risk rating 2.0 from NFIP. So as insured saw there were rate increases coming, some of them might have jumped onto the private market prior to the implementation. NFIP doesn't allow you to cancel your policy midterm and get a refund of the unearned premium. So it would be beneficial to some insureds to get that prior to the risk rating 2.0 implementation and any rate increases they would have had to pay.
Have private flood insurers been driven to add that capacity in the past, and the demand just hasn't been there until now?
With risk rating 2.0, you're getting to more actuarially sound rates for flood, which means prior to that, it was basically for the insured less expensive to get NFIP programs than what it would be on a private market. So it was suppressing the demand for private flood insurance because the government's basically subsidizing the insurance. So with that going away, yes, you'll see more moving to the private market. Also, now, just earlier this week, the FHA announced that they will now accept insurance from private flood carriers instead of mandating an NFIP policy. So that would also likely move more insureds into the private flood market going forward.
David, is there a notable dynamic between the admitted and the non-admitted flood market?
Well, yeah, I'd say there is, John. I think, definitely, the admitted marketplace has definitely tightened considerably in recent years, but still with that, the availability and affordability of private flood insurance, continues to evolve. And I think we've seen that in terms of, some of the non-admitted companies coming into the marketplace and taking advantage based on their risk appetite of writing risks that they look for that meet their criteria from a risk selection standpoint. They are also able to use their freedom of rate and form to again provide policies and provide coverage that again meets their standards and obviously meets the market need. I think from an admitted perspective, I think we're still seeing the chance for some of the admitted marketplace to grow. Some of the admitted carriers are even offering real-time online platforms for flood coverage. Again, more user-friendly, so that's giving them an opportunity to gain or to write the business that again meets their criteria. I think when we also look at it, the private insurers, differentiating them, whether they be admitted or not admitted, from the NFIP carriers, they don't need to deal with some of the constraints that the NFIP carriers have to deal with, like the 30-day waiting period in certain cases that are involved with the NFIP coverage. So again, I think you see some of those dynamics in the marketplace between NFIP and non-NFIP and private coverage, and also some of the opportunities between the admitted carriers and then, like I said, the non-admitted carriers that can come in and again use their freedom of rate and form to provide coverage for those high risk coastal insurers, those high net worth insureds that might have their homes and properties near the coast that need surplus lines carriers to come in again to provide the type of coverage that they need. So I think we've seen that dynamic working, in the favor of surplus lines or non-admitted carriers. But I think we've seen the private carriers, even on the admitted side, still able to grow out their marketplace in terms of as Chris mentioned, they're more finding things more affordable or more to their liking, with risk rating 2.0 kind of pushing up the pricing on the NFIP coverages to where the private insurers can compete a little bit more. So they're seeing some opportunities there. So I think both the admitted and non-admitted marketplaces are finding some opportunities. Like I said, there are just some nuances between the two.
Chris, is risk rating 2.0 enough to get the NFIP out of debt, especially in the wake of Hurricane Ian?
Not likely. Certainly not in the immediate future. If you look at the history of the NFIP program and its debt, up until 2005, any debt that the NFIP had, it was able to pay back. However, with Hurricane Katrina, that debt has not even been paid back in full yet, and subsequent storms have only made it worse. The debt for NFIP is currently at about $20 billion. That's after $16 billion was forgiven by Congress a few years ago. Hurricane Ian is going to be likely one of the 5 largest flood events ever. So yeah, that $20 billion debt's only going to get worse. I don't see how there's enough premium collected, to immediately pay back all the debt, even if there's no storms for a few years. So it may be enough, but certainly not short term.
David, should we expect the private flood market to get more competitive, or is there a reticence on the part of writers to get involved?
I think the market has and will continue to be even more competitive as we look forward. And I think as private insurers, be they admitted or non-admitted, develop more coverage options for the marketplace, I think that's where we're going to see the expansion. We mentioned, obviously, and I think you mentioned at the top that in 2021 we saw a 40 or 42% increase in private flood coverage. I think that's a reflection of again some of the competitive impact of in the marketplace related to risk rating 2.0, but it's also the opportunities that companies are looking for as they refine their underwriting standards and their risk appetite, and in the areas that they see that they might be able to come and make a difference and obviously make a profit. I think we'll continue to see that, and we'll continue to see the marketplace evolve from that standpoint. I think the primary carriers that can find the best reinsurance program support or the best support for their portfolio, I think those are the ones that are going to be able to offer the greatest help from a market perspective. So those that have the stronger reinsurers behind them, I think that's going to make a big difference overall in the marketplace. And I think as the insurers continue to assess their losses from the 2022 storms, the ones that obviously kind of came through, more favorably, or maybe even more favorably than they might have expected, I think you might see that manifest itself in terms of coverage offerings in 2023. So the marketplace still continues to evolve, and I think it's something that AM Best will keep a close look on as we head into next year.
David, Christopher, thank you so much for taking the time to speak with us today.
Thank you, John.
Thank you.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.